Hello and welcome to Switzer TV. I'm Peter Switzer. And today it's time to look at 5 unbelievably good stocks from week 3 of reporting season. Paul, let's kick off with one of the best, CSL.
Yeah, let's start with CSL, Peter. On the headline level, the profit of $2,103 million, only up 10%, probably less than the market was expecting, but their so-called currency headwinds were a bit higher than expected. So on a constant currency term, which CSL likes to measure by, up 17%, that was better than expected. Revenue up 9%. Final dividend US $1.07, about $1.48 in Australian dollars. Now, looking ahead, they guided to revenue growth of 6 to 10% and NPAT of between $2,100 and $2,265 million. Now, that was less than expected, but they're also spending an extra $100 million US on R&D, and that gets expensed. A lot of that's going into COVID-19. They've got a partnership for one of the vaccines, potentially with the University of Queensland. They've got 4 treatment candidates, so they're all potentially upsides. And one of the big concerns for the market, Peter, had been about the cost of getting plasma and their collections. Now, the collections are actually better in the US than anticipated. And CSL said, built into those numbers are going to be a higher cost for collecting plasma this year, but those costs are going to be temporary. So if you look ahead to FY22, CSL is looking pretty good. Now, I want to just show you the share price because, since, if we just go forward to show what's happened to CSL this year, when the market plummeted in February, March, CSL held up really well on a comparative basis. And it's basically done nothing in the last 3 or 4 months as the market has rallied from when the ASX got down to 4,600 to about 6,200. This is a return to form for CSL, Peter. Yeah. Better than expected when you adjust for currency, better than expected when you adjust for R&D expense looking ahead next year. That's why the market went up. CSL remains a core stock. I reckon it's a great company. Still an opportunity to be long in this stock.
And you buy it on the dip. Next one, BHP.
Yeah, BHP's underlying profit was down 1% to $9.1 billion, but that still represented a 17% return on capital, so they're raking in the cash. Look, lower prices for copper, oil and coal, offset by some benefits earlier on the year of foreign exchange. Iron ore, 64% of EBITDA. Now looking ahead, the iron ore price this year is still a lot higher than it was last year, so that's all positive. Final dividend of 55 US cents, that's 76 cents Australian. The production guidance is a bit lower, but I think the main thing about and they've also cutting their capex by $1 billion, so that points to sort of their being very fiscally prudent. I guess the major thing on the report, Peter, was a bit more around positioning of their asset base. So they're getting out of energy coal. They're going to look at more premium approach to terms metallurgical coal, and also their oil assets will be focused on more higher margin oil assets. Big believers in copper and nickel. Haven't done a lot on the nickel front yet, but if you had to see in terms of their asset mix, that's where they're trying to position to, out of coal, into nickel and copper. And maybe the question around potash remains as uncertain as ever does.
And if you believe in an economic recovery of the world economy, nickel and copper are real beneficiaries, aren't they?
They are, and I think that, and partly the whole move to electrical batteries and all that sort of stuff. So that's really what's driving BHP. I think the other thing there is it is still a cash driver, and commodity prices are okay. BHP is going to return great dividends for shareholders in the short term.
And China is growing better than most countries. Let's go to A2 Milk now.
Yeah, look, I like this result, but the market did. In fact, it fell on the back of this result. Revenue up 33%, earnings up 33%, and net profit up 34%. I find it hard to get too worried about those sort of numbers. The main reason here, perhaps the market fell, is A2 Milk has done really well over the last 6 months.
Company good. External forces.
And the market's a bit nervous about sort of the whole Chinese sort of sales. Now that's sort of coming from 2 directions. One, of course, we saw what happened to TWE and the wine. People are worried about sort of, well, if they're doing a couple of these industries, could infant nutritional formula be the next? And I guess also the way that they're selling that, it's increasingly, with tourists locked, can't get into Australia, the whole Diageo sort of network a bit under pressure. Can they really sustain some of the growth? Maybe there was some stocking up in advance of some of these changes. So that was probably the concern. Also, the EBITDA margin for their forecast for next year of 30 to 31%. That was probably a little lower than expected. That's implying higher costs. I thought it was pretty good, Peter, but you can't please everybody. Have a look at this chart. That's one of the reasons I like A2 Milk. Revenue up every year, earnings up every year, earnings for shareholders up. I think they're the sort of companies you have to back.
That's the kind of report any CEO would like to show to shareholders. Let's go to the next one, JB Hi-Fi, another great performing company.
Now, a huge winner out of the COVID-19 lockdown, but even so, still excelled. The $333 million was better than the market expected. Sales up 11.6%. Have a look at those quarter four sales in the fourth quarter, up 31.4% for JB Hi-Fi Australia, but also the Good Guys business, which hasn't been a struggle since they purchased it, up 30.2% in the fourth quarter. Importantly for the shareholders and the way that they're doing business, their cost of doing business was down, and so their margins, their EBIT margins were up both for JB Hi-Fi Australia and also down one better margin for 1.21% for the Good Guys. So not all plain sailing. The New Zealand business hasn't done so well, but that's too small. Dividend 90 cents. July sales up 44% compared to the same month last year, but obviously, looking a bit tougher as we go into August and the lockdowns. Again, the chart I really like with JB Hi-Fi, sales, underlying NPAT and earnings per share over a 5-year period.
It's funny, Paul, as I listened to you about JB Hi-Fi's great results, I thought this is the strangest recession of all time. That during a recession, we're spending like there is no tomorrow. Let's go to our final
and it's interesting who's the winners. And this is another winning company
right.
out of the COVID-19 lockdown is Wesfarmers. Net profit up just short of $1.7 billion, but from continuing operations up 8.2%. That's a positive. Final dividend of 77 cents a share. That was higher than expected. Plus a special dividend of 18 cents per share. That's as a result of its sale of its 10.1% holding in Coles. Bunnings, as you and I know, Peter, if you go there most weekends, it's the powerhouse. 64% of group earnings. Earnings up 13.9%. And look at those second half sales, up 23.4% in the second half compared with the same half year last year.
I think I can see my garden in there as well.
You probably
Paul.
can. So another huge winner. Officeworks has also done really strongly. Not all plain sailing for Bunnings. It is a conglomerate. So still some challenges with the Kmart group. That's more in the Target part of the business, and they're rationalising and closing a lot of the Target stores. Still, that's a work in progress. And they've also got an industrial safety division and the chemical, energy and fertiliser division. They're also doing it a bit tougher. So, look, I think a positive result, more so for the dividend. Again, I guess Wesfarmers still sitting on a lot of cash, still hasn't made a lot of investments following its sale of the Coles business. So still opportunities for the Wesfarmers model, but it is a winner. Out of COVID-19, and Bunnings again has been a huge winner and just keeps on doing it year in, year out.
And happily, those 5 companies we've been strong supporters of, and they're really. I think it also underlines the point, Paul, that you buy quality companies when markets sell off big time. Thanks for joining us on Switzer TV.